Hello, hello everyone. Hi. We have a few people trickling in. And so I just, want to see where is everyone joining from? Is everyone here in the Bay Area or do we have some stragglers from, I don't know, sometimes we get people from New York or Seattle or anywhere else. I see San Francisco, LA. Oh, nice. Great. SF. Great. We have a lot of locals. Um, Great. Yeah. And so while we're waiting for, I feel like people kind of always just trickle in. I was thinking maybe we can do some intros. People can share what they were interested about this session. And then I could also do a brief intro about Funding Breakthrough Lab before we hand it off to Bhuva. So Nina, I've seen you before. So how about I call you out and you can do a little intro and what made you interested in during today's session? Yeah.
Yeah. Wasn't prepared, but that's okay. So yeah, I'm kind of planning or preparing to start raising end of January, something like that. So I have early traction and MVP, and I attended a couple of your prayer workshops, and you're doing a really great job. Thank you. So yeah, just kind of wanted to get back on track. I was planning to raise earlier this year, and then had to pivot and reshuffle, and as it always happens, the chaos of early stage. So yeah, just kind of want to catch up with what's the latest and learn.
Okay, great. Thanks for sharing. Henry, I see you're off camera too, so I'm gonna pin you.
Yeah, nice to meet you over Zoom. My name's Henry. I am located in SF. Yeah, I was just excited because this seemed like a really founders-focused program. Liked some of the posts I'd seen about it, so was interested to learn more. Probably will go in to do like a larger kind of seed round in the next year, so was applicable.
Nice, great. Can I get anyone else to volunteer and do an intro? I'm gonna call out Sue if you're willing.
Yeah. Hi. So I'm a founder for an early stage startup, and we are thinking we might need to raise this coming year. So I thought maybe it would be good to like join this and see if it's gonna help. This is like my first time, so yeah, hoping for the best. Thank you.
On mute. And I'm guessing most people here are like first time at fundraising or about to do their first fundraise. Is that the case? Feel free to like type it in the chat. Yeah, I see Yasser said yes. Sue's yes. Zashan, yes. Yeah, great. Someone sent a LinkedIn connection. Um, Delaram, am I saying am I saying your name right? I don't know if he's still here. Well, thanks everyone for chiming in. So I'll just do a quick introduction of myself. I'm Natalie. I'm the founder of Funding Breakthrough Lab, which is a nonprofit pre-accelerator. We actually started earlier this year and we've done two cohorts. And how it started was when I was in my founder journey, I was like, hey, if I was going to go fundraise, what would I want to know? And I felt like there was a knowledge gap because everyone was always going VC, VC, VC. And I ended up building Funding Breakthrough Lab to kind of answer that question. So we cover everything from like crowdfunding, get people to speak about grants, loans, family offices, angels, to really understand the ecosystem and like what sources of funding there are out there and why we do it. We do a lot of pitch practice throughout the cohort. We do like 3 sessions and a pitch competition at the end. And we get about 30 to 40 speaker mentors, judges per cohort. So it's almost like a 1-to-1 ratio of like, founders to kind of like mentors. It's very high touch. And we'll have a next cohort end of March, and we're doing a fintech, health tech focus for that one. So we'll get speakers specific to that. And then we host a bunch of events such as this one to just provide resources and information to founders. And so with that, I'm going to introduce you to Bhuva, and I'll let her take over and start her session. Yeah.
Thanks, Natalie. Thanks everyone for joining. I'll start sharing a presentation, but feel free to drop in your questions in chat. We'll take it towards the end. Happy to answer if there is anything that we've not covered today. Let me get started. And again, like I mentioned, I'm Bhuva Shakti. I'm the founder of WalletMax, but I'm also a startups advisor. I focus on predominantly product development, operations, as well as end-to-end fundraising. I work with pre-seed, seed, Series A, and Series B startups across tech-enabled sectors, which is like every sector at this point in time, starting from 0 to 1, launch to fundraise, or if you have traction already, then potentially fundraising for your growth stage, which is expansion into Series A, B, either products or markets or both. Typically also I work with more corporate leaders because some of the funding sources could be from institutional investors as well. So it's important to know, like Natalie mentioned, what are the types of funding sources that are applicable to you, specific to your market, your product or service offering, specific to your startup stage, and also the economy, right? So what's going to work today versus what's going to work in 2026. We'll focus more of today's session on what's coming up in 26 versus what has happened in 25. By way of background, I've also spent a few decades on Wall Street across technology and banking and policy circles, but more importantly, product development, operations, finance, and business expansion. I'm happy to connect on LinkedIn as well. I've put my LinkedIn in chat. Feel free to connect with me. With that, a quick introduction about WalletMax, where we lead a community of 2,000 odd members. We are growing every day. Our goal is only fundraising access for startups that are product focused and tech focused. We don't do anything else. In this sense, we have community members that are in the startup space, ecosystem leaders, corporate sector in terms of institutional support, as well as investors. They could be anywhere from angel, VC to private equity. Those are the only three that are typically in our community. Till date, we've also individually invested in 10 odd startups, all tech focused as well, but across fintech, AI, climate, and other sectors. Our membership is also open to wide range of expertise, like it could be in college or a university, it'd be in academia trying to launch a startup from your funding lab. It could be a nonprofit. You could be an investor or actively fundraising startup that has traction in terms of revenue or customers. So everyone has a different type of membership within our community. We've had about 60 odd partners this year. So feel free to check out. Contact information is on the slide as well. Now, I want to deep dive without wasting any more time into our topic for the day. What's a fundraising sprint and how do we approach it from a tech founder, especially if you're a founder as well as an operator? How can you showcase investor-ready growth? This is also part of something I do with the pre-seed, seed, and Series A startups, because many of these components are applicable to these three stages, not so much Series B, because it more so depends on how much traction and growth you have. Not necessarily there are different type of criteria between pre-seed, seed, and Series A. So we'll say this session is focused on more around pre-seed to Series A stage, and if you're tech focused and product-based startup. In terms of what do we need before we start fundraising, right? You can't just create a deck and start reaching investors, because what would potentially happen is when you're in the middle of a fundraising cycle, you might need many more things. And that time, it could be really time sensitive because you have to get back to investors in a short period of time. And if they don't hear back in a timely manner, you might lose an opportunity to continue the fundraising cycle. So it's really important to plan a 12-week sprint plan, treat fundraising like product execution. more structured, measurable, but also time bound, right? You may not have to do everything every week, but you need to continuously keep adding momentum to show progress, because you have to run a company also while you're trying to fundraise in parallel. So it's important to balance your effort on both sides. As we know today, like investors, when we look at the forecast for 2026, some of them are taking much longer to decide. Sometimes it could average between 60 to 90 days from your first meeting with an investor to the time they commit the check to you. So it's really important to keep that in mind while you run your business, continuing to engage the investors for that amount of time. And it's really important to ensure your preparation and a sprint process, like how you develop your product, is really important. And also, sometimes founders, if they are operators, they can think of this as a capital acquisition project, right? We are here to approach capital like how we approach a product. You define what's your target, you test it, refine it, and close it. It's going to be an iterative cycle. It's not like one time done and you move on. So today we'll work through a 12-week sprint model. How does it look like? What is the bare minimum that you need to get started? You may not do everything on day one, but at least you need a 10-slide investor deck. And then we'll also look at a readiness framework that you can start with even this week or next week. You don't have to wait, like, let's say, 4 more months trying to prepare and plan. One of the key things is you should have some kind of traction and vision. Traction need not be always revenue traction. It could be customer traction, it could be LOI, potential partners. There could be many different ways that you can define traction, but also you need to have vision, not a company vision. Rather, once you get the funds from the investor, what is your vision to deploy that capital and to grow and use the capital more efficiently? And one thing we'll also talk about today is how can we build systems and processes so that your fundraising is repeatable? Sometimes you may be raising multiple rounds. You may raise a pre-seed angel round, then you may need a follow-on VC round or something in between, like a bridge round, or maybe a late-stage capital. Once you build some of these systems and processes, you can keep making this fundraising a more repeatable process. It could be also between different investors in the same funding round. Let's assume you're raising a seed round as an example. That could be like 10 investors you are reaching out. You could use the same repeatable process. And it's also important to tighten your growth benchmarks and metrics, because in 2026, investors are going to rely on that. Of course, it was always important, but now that investors are making little bit late decisions, you're going to be engaged with them for 3-month period, at least at the minimum. You need to have all those metrics and KPIs that are quantifiable, readily available and tracked, and be able to put in front of investors on a regular basis. The recommended cadence is a weekly cadence, so which means every week you're going to measure your progress, report it to the investors, and if need be, you can adjust as you go along, because sometimes you may get an investor request that may ask you to create some more information, get some more traction before you continue the round. So it's really important to structure that, but also be able to pivot that if need be throughout the pathway. And one more thing is it's a long process, which means try to time box it, because you need to plan your day-to-day and your weekly activities between running your business and fundraising to grow your business. So you can't have only one at any point in time. You need to run both in parallel, which means time boxing is really important. Measuring really important as well. And more importantly, it's not just only about the founder, but also your team. Everyone in the team is also fully aligned with what's happening, what are their individual roles and responsibilities when it comes to fundraising and the data room prep and things of that sort. Probably something like, let's say every Friday, you're going to have a team meeting. We have a quick check-in on the fundraising momentum, as well as product and customer traction. That way, you're able to do a check-in of everything together with your team on a weekly basis. So it becomes part of your team meeting rather than fundraising is a separate process away from your day-to-day team activities. In terms of investor readiness, investors have always focused on traction and retention. That's really important. And as you may already know, some of the angels fill early gap before the venture capital investors. So the definition of traction and retention could be slightly different from angels versus VCs when you reach out, and also within VCs, it could be slightly different between early stage and late stage. But end of day, investors want to know how your growth is converting to capital efficiency. You may have traction, you may be generating revenue, but are you using the capital efficiently? In the sense, if you are raising $1 million, is your growth at least 3 to 5 times X? That way, your capital is being used efficiently to expand business at least 2 to 5 times more. They also look for founders with both domain fluency as well as quantitative metrics focus, because it's really important to be a founder who knows where they are solving, what problem they are solving. You might not have technology expertise, but that's okay because you can always get a CTO, someone who can help build you the product. But then it's really important for the founder to have the functional knowledge in terms of how the customer problem is going to be solved. One of the things that investors will be also doing in 26 is being more cautious in terms of reviewing traction, because they want to see traction that has some backing for future growth. It may be okay that you have traction today, but can you continue to produce this traction and momentum on a month over basis and a year over basis for the next 12 to 18 months at least? They also need to know what is the proof of customer behavior when it comes to the market problem you're solving. Is it like a one-time thing where the customers like your product, buy your service, and they don't talk to you for a month or a year? Or is it more like they're going to keep coming back on a repeated basis? Because when you show repeatable customer progress, then you're already speaking the investor language. Because it's not about acquisition alone, because acquisition, of course, showcases growth, but retention and less churn is really important when it comes to customers. But also, when you run a pilot, it demonstrates market validation. They look for revenue path clarity, which means, like I earlier mentioned, is it one-time revenue? Is it short-term revenue? Or is it going to be a long-term, consistent, and continuous revenue? You need a clean cap table. So if you have a lot of advisors who may not help you or do anything valuable for your business, try to look at that. If you have team members who have left your team, who are not part of your team today, but your cap table has their name, try to clean it up. So having a clean cap table is really important to give confidence for investors that when they are ready to hand over the check, there are no legal challenges. And it's really important, like I mentioned, you need to have a 12 to 18-month plan on how you will use the funds that you generate from the fundraising in the current round. Are you able to transparently show projections? I mean, projections may not be 100% perfect, but it should be realistic enough. It should not be overblown or it should not be undervalued. So it's not about perfect numbers, but it's also ensuring how realistic and transparent you are. So a clean cap table, a metrics dashboard, one page of use of funds plan. These are all really important in the preparation phase before you even reach investors for fundraising. Now let's get into the 12-week fundraising fast track sprint. Like we saw earlier, fundraising, it's an execution sprint meaning it's time boxed. It's not an open-ended project because you can't fundraise forever because you cannot run your business beyond a certain point in time if you have a open-ended fundraising cycle. So I'm going to try to split 12 weeks into 3 phases. More like phase 1 is the first month, the first 4 weeks. Let's call it preparation. You're doing enough preparation so that when you are in phase 2 for the next 4 weeks, you are consistently engaging with investors and not creating a break in the cycle to go back and prepare something again. So that's really important to continue to push the momentum. And the last phase is close. Even after you have commitment from the investor to invest in your current round, there are so many other things that we need to take care in the closing phase. And remember, fundraising is not complete until the money hits your bank account. So you may have a check, you may have a legal document, but if the money is not in the bank account, then you are still not closing the cycle. So it's really important that we have clear start and end dates for each of these phases. That's number one. You have a weekly cadence and reporting. Sometimes it could be self-reporting, but ideally it's helpful if you are able to hold each other accountable in a team or even send weekly updates to investors you have met so far. They may not have expressed interest yet, but it's good to keep them warm. You can also combine qualitative and quantitative data. That's really important. Having not all quantitative data is not going to give you a lot of indication on the future possibility of where the market is headed. So it's really important to combine both. And also try to review progress, like I mentioned, with investors that you are iteratively reaching out. For example, if you reach out to 2 investors in week 5, 3 in week 6, continue to send updates to all 5 investors from week 6 onwards. So don't try to disengage because investors may be going through their internal process to come back to you with a decision. And we want to ensure they are kept up to date with your updates. And over this 12-week, the goal is like a product release. If you're a tech founder, you know this already, where you set the targets for your product, you build it, test it, iterate it, fix issues, launch, relaunch, right? It's very similar to that, where phase 1 is preparation, it sets the foundation. Phase 2 is engagement, where we are building momentum. And phase 3 is the closing. It's more around not just getting a legal agreement signed, but also ensuring the money hits the bank account. And accountability is also really critical. That's why I mentioned at the start, it's important on a weekly basis as a team that you review product progress, company progress, but also fundraising progress with your team. Because if you are able to run product sprints, fundraising should not be any different. It's another 12-week sprint that you will be working along with your product development. And when it comes to committing to a real date, definitely put actual dates for these 12 weeks. Don't put an imaginary date and keep moving it, because then probably it might indicate even to your own team that you're not ready to fundraise at this point in time. So as an example, between today and next Monday, even your week 0 could start next Monday. Nothing is stopping you from that. And week 1 could be the first week of Jan in 26, where you are in the live preparation phase. So in preparation phase, we have weeks 1 to 4. You'll first define your target investor profile. Not all investors match all types of startups. So it's really important to find the right investor that match your market, your industry, your customer profile, your business model, and your company stage. And then build a list of 50 to 100 prospects. Don't try to reach 1,000 investors. Don't send 1,000 cold emails, because they are going to drain your time and energy and may not yield results as you expect. Week 1 to 4 in preparation phase, it's also important to create your 10-slide pitch deck. I mean, there are many thoughts around how big a pitch deck should be. Ideally, 10 slides are sufficient to get investor interest. You can put any number of additional slides in the appendix, and as needed, you can bring it up in a conversation. But if you send too much in one shot first time to the investor, they may not even look at every slide, and you might think that you're not eligible to fundraise, while on the contrary, they might not even look at your pitch deck. So really important to stick to 10 important slides, at least for the first meeting, and ensure to have your
I want to. I'm completing the reference now. What is chain position? What was the chain position for
And are
controller?
you asking us or are you not?
Oh, sorry.
I think that was a mistake.
All right. No problem. So, like I mentioned, target your right investor profile, build a list of 50 to 100 prospective investors that you can reach out in this 12-week sprint. You might add more later, but to have momentum, and definitely create only a 10-slide deck, put everything else in appendix. And it's also important to verify your acquisition and retention data. Even while you're fundraising, it's important to show progress to investors on your acquisition and retention, because like I said, it might take 3 months, 60 to 90 days is the general timeline that we are seeing for 26, which is the 12-week that we are talking about. So while you're fundraising and talking to investors, you can keep updating your acquisition and retention data that shows momentum for the investors. Data room is again really critical. Data room may look like a fancy term, but it's nothing but you can create a simple Google Drive or Dropbox or set of folders where you can put all the important legal, financial, business, product operations documents, so that you don't have to send one by one on an email to investors, because they like to see everything in one shot in one place. It's also important to have a one-page summary memo along with your pitch deck, because sometimes investors will just ask you to send a one-page summary and then obviously go to the pitch deck. So have a one-page summary and a pitch deck handy. And definitely don't forget to create your weekly update template. On a weekly basis, you're going to send weekly updates on how your business is progressing to investors you have been reaching out on a weekly basis, and you keep adding more to that list. This is really important to build and maintain credibility while you're fundraising, while in the process of fundraising and running the business. And one more thing is also when it comes to dashboards and weekly reports, don't try to build something and spend time perfecting it. It could be as simple as a spreadsheet also that can summarize your traction. Clearly, it's really important to make this more repeatable. When you simplify a process or a workflow, you are more able to, keep up with the weekly process instead of trying to get complex into the weeds, right? So just to quickly summarize, in preparation, building target investor profile, identifying 50 to 100 prospects, having one-page memo, a 10-slide deck, and a weekly update template with a simple spreadsheet of all the metrics that you track on a weekly basis while you are pursuing this 12-week fundraising journey. And one other thing is also really important, where quality over volume is critical. Sometimes you may not even need 50 to 100 names, even 50 names is plenty, because that itself is going to take a lot of your time in trying to do follow-up calls, meetings, in-person meetings, demos, and discussions. If you try to have too much, then you might not answer each investor question in a timely manner, and investors value timely response more than anything else. Now, once we have this preparation done, in phase 1, we move on to phase 2. Phase 2 is all about engagement. We are not preparing anything anymore. There could be some items that are still incomplete, but that's okay. You should, week 5, day 1, start outreach. You might have 2 set of contacts in terms of warm introductions and cold introductions. A warm introduction, I believe you may already know, someone knows someone, they can connect you or you know them personally. A cold introduction is you have no connection or no network with them personally or from your extended network, and you're trying to reach through a cold email. Try to prioritize warm introductions first, personalize each investor outreach. Don't send common emails. They typically end up in a spam box that an investor may not even reach out. Try to send weekly investor updates. Weekly investor update need not be complex. It could be a simple mail of what happened with your product, operations, business, finances on a weekly basis to your investor. In a simple email, that's fine. And more importantly, now that you're in phase 2, you're engaging, which means each investor could be in a different stage when you're talking to them, meaning your outreach to an investor in week 5, maybe in week 6, 2 more investors are in a discussion phase. Then week 7, 2 more investors are in a diligence discussion. So it's important to maintain the investor list for different types of fundraising pipeline, meaning initial outreach, discussion happened, we are in due diligence, or data room review. The investor had more questions. They are checking metrics. So it could be any different type of ask from the investor to try to maintain the list of investors based on what they have asked. And sometimes what happens, you've prepared a pitch deck in phase 1. Don't try to keep it static. If an investor asks a question and if it really helps you bring out the story much better, emphasize your traction, then make a quick update to the pitch deck, send it back to the investor so they can see everything in one place before they make a decision. And one more thing, it's also really important is traction is like really very important than vision or anything else. Like I said, it could be customer traction or revenue traction or both. If you have repeat customers, let's say 1,000 people coming back to you, you've not generated profit yet, but they have not churned, then that's a good indicator for the investor to invest, even though you don't have profits yet, because it's going to come with scale. But if you have less number of customers who have not repeatedly come back, who have dropped off in a month or 2, and you don't have revenue traction, then might be you are too early to fundraising. Maybe you might have to wait a few more months before you generate customer traction, if not revenue traction, before you talk to investors. And one thing it's really important to remember is phase 2 is outward facing month, which means you are constantly meeting investors, sometimes virtually, sometimes in person. So you will have to plan your schedule. And that's why we spoke even before phase 1 started, that your team should be up to date when you as the founder is out there fundraising. Who in your team is responsible to ensure your product, finance, operations metrics are continuing to still grow and not go to a stalemate. So that's really important to understand. And that's why the weekly update to investor and a weekly team meeting is really important. Sometimes you may get a no. I mean, if you reach out to 50 to 100 investors, it's possible 2/3 may say no. And that's okay, because when you get no's, you can ask what is the reason, why, and you can update the pitch deck and reach out to a different investor. Or if there is a misunderstanding that they didn't see your traction data very clearly, then probably you need to fix your slides or your traction data and go back to them. So it's really important that when you hear a no, don't stop or disconnect. Go back and ask the investor as to why and why not, so that you're able to fix it and go back to them. If not to this investor, maybe to a different investor. So both are okay. Now, in terms of the final phase, we are in phase 3, which is closing. It's typically weeks 9 to 12, your third month. Now, you're not preparing anymore. You're not outreaching anymore. You are really engaging with those top set of few investors who showed interest. If there are a set of investors who didn't show interest in phase 3, third month, don't spend time trying to reaching them, but put your energy and effort more into those top investors who reached out to you, who want to learn more about your metrics, your traction, and things of that sort. So this is the time where your data room comes handy. Now, when like 5 investors want to talk to you, review your data room for legal, finance, and other business documents, you don't have time to go and create a data room, which means you've already done that in phase 1, and you're just going to share with the investor without wasting any more time. Very important, like I mentioned, you need to negotiate with the investor. If terms are not acceptable, engage a legal team, but definitely don't try to sign up something for the reason to close the current fundraising round, because fundraising, once you get the check, your investor is going to be a team member with you on a day-to-day basis in your company. So if you are not quite aligned with the valuation terms, then it's okay to negotiate than try to accept it, because if you are misaligned with your investor, you cannot run your business once you get the fundraising check. It's going to be a day-to-day nightmare. So it's really important to document any and all verbal commitments, get legal approvals, ensure this is a long-term plan that you can stay with, your team is able to align with before you do the final closing. In the final month is also very important, where sometimes when you close the current round, you're not going to lose contact with the current investor. It's really important to keep in touch with investors who said yes and investors who said no. Because sometimes an investor who gave a no to you today may come back in a few months for your next round, because that would be the right opportunity for them to deploy their capital. So you have 3 different categories of investors who are really very interested, mildly interested, never interested. So focus on the top category first, but definitely keep the second category warm for a next round. Don't bother about the third category, because that's going to take your time and energy without any efficient outcome. Now, when you go through these 12 weeks, we spoke about a metrics dashboard earlier. You can also track things like what is your outreach count and response rate in that, like how you track your product traction, customer traction, your finance traction for your business, even investor fundraising journey. You can track how many calls you booked, how many really happened, because sometimes you may book the call, it may not happen, how many investors followed up, how many deck iterations were done, meaning some investor may ask some changes. How were you able to showcase traction growth? Have you been sending them the conversion funnel view? Have you logged lessons learned? And also, every week you're going to revise next week's priorities, because you may have a new learning from an investor meeting this week, and you're always allowed to shift it. Your dashboard, like I mentioned earlier, could be a simple spreadsheet, a Notion table, need not be anything like a new software tool that you need to develop or purchase. But refreshing data on a weekly basis is really important than trying to create a much better dashboard. So quickly summarizing, phase 1 is preparation, phase 2 engagement, phase 3 closing. 3 types of investors. Level 1, warm, really interested, keep them engaged on a daily basis, weekly basis. Level 2, slightly interested, not deploying capital today, but definitely keep them warm for a future round. Level 3, cold, no response, no potential. don't spend time on them. Now, though there are many different materials that we need to fundraise, I just want to quickly touch upon only the pitch deck because that's something everyone needs, in addition to data room and one-page summary and many other things we spoke. These are like the 10 core slides we need. Number one, definitely, what is your company name? What are you doing? What is the problem you're solving? Those are like the key slides at the top of your deck. Then what is your solution? And how is it addressing the market that you're launching today? And how efficiently? You may have a total accessible market like billions of dollars, but what's your initial target market entry today? And how is your solution going to solve the problem and capture customers? Then more importantly, traction. We've spoken a little bit on that already also. So traction could be customer, revenue, partner, letter of intent, or all of the above. What's the type of traction that's relevant for your business? Then the business model. Business model, it could be any type as long as you have validated with the customer. There is no right or wrong business model. The only business model that matters is what keeps your customers to continue to buy your product or service, the one that generates revenue. So it may not be visible day one, but it's going to only take through multiple iterations, but you should have some business model that you have tested, even if it's only one side of it, to be able to show the investors. Team, really important. Growth plan, meaning not about fundraising, but once you receive the funds, how are you going to grow? And then ask. So what's your ask? Is it for a 12 to 18 month runway? Is it a bridge round? Is it a growth round? What is your vision to use these funds more efficiently? So if you see in all of these slides, each slide should have only one purpose. Don't try to mix solution and market, business model and traction, because sometimes there could be multiple team members in an investor team. They may not all look at each slide. They may look at only a traction slide or a financial projections slide. So it's really important to have 10 clear slides that have one purpose. Use simple language because not all investors may be tech savvy industry experts. They will have some knowledge, but if it gets too complex into the technical and advanced industry concepts, they may zone out, in the sense they may not even understand who you are building this solution for. Definitely important to not have generic claims, but use proof points, meaning 10 customers told us this and we built it. 5 of them were able to repeat product or service purchase from us for the next 3 months. That's a good proof point versus trying to say, hey, our customers always come back. That's a claim. If that is not supported, then investors will easily skim through to the next startup. So these 10 slides should be easily readable by an investor in less than 5 minutes. It's possible that you may have more data, but not for the first meeting with investors. If they like what they see in less than 5 minutes in a 10 slide deck, they will come back to you for a meeting. At that time, you can add more details, bring more materials to show what you're looking for. In terms of the problem definition, really important to try to see what type of customer and what pain you're solving. You may not be solving 10 problems for 10 customers on day one. If that is the case, investors may not be able to invest in you because they think you are too spread thin, not focused on one or two types of problems. So really try to narrow down some of the niche problems and what type of customer, quantify the pain, try to showcase how the problem is also a general industry problem. Meaning if 10 customers have a problem, you can see that 100 people in your research also have the same problem. Then the market expansion potential is high because investors are not investing to serve 10 customers for you. because they want to develop a solution for a problem that may solve customer problems in the millions or billions. So it's really important to show that trajectory in terms of the type of customer problem you're solving and how the problem is so big that you have to develop a solution and you are the only person who has a unique value proposition. One mistake many founders sometimes make is trying to say, I'm the only one building this, I have zero competition. Then that's a red flag for investors. It's good to have competition, but tell investors how you are different from your competition and how you are going to acquire their market instead of trying to say, I have no competition. Then you've not researched your industry as much as it needs to be. Similarly, in terms of traction, retention, acquisition, quantifiable numbers, define your initial market, though there is a big market. What is your current market focus for this particular funding round? That's really important. If you have some test customers, it's good to also include some testimonials, because testimonials are proof that the customers are really valuing the product and the service you provide. As we spoke earlier, we win metrics everywhere. Metrics are really important. In terms of team, you may have a lot of team members, but it's really important to show only those that are relevant to this fundraising round. Meaning, if this is a tech-heavy fundraising round, probably have your CTO, your engineers, your finance team, they are more important. But if this is going to be an expansion fundraising round, then your operations team is really important, because it's not about building an initial product, it's about scaling it across markets. So operational expertise is more important. So try to find out what's more relevant and not showcase every team member to avoid confusion for the investors. Advisors, really important. We spoke at the start of the discussion itself in terms of cap table. If someone is not doing the work, adding value, you have to rethink your cap table and showcase those advisors to investors. Because if your cap table is not clean with people who have no value to add, investors more likely won't be able to invest in your business, because they already have made up their mind that you have an inefficient business model. In terms of revenue and profit break even and traction, have a clear idea for your pricing logic. Why did you come up with this kind of pricing for your product today? Is it a monthly subscription? Is it one time, pay per use, or are you going to do a freemium? What is the business model? How did you come up with the pricing? It may not be perfect as long as it's in the range. And do you know your unit economics? Unit economics is nothing but to develop or deliver one unit of product or service to one customer, how much you spend, how much they pay, and what is the margin. Is it positive, negative, break even? That level of detail is important. Investors look for unit economics than larger revenue projections, because sometimes when you show the big revenue projections, it may look like, oh, you have a $1 billion, $1 million business. When you go down to the unit economics, you may see that you are hardly making 1x or 2x on the cost that's going on in terms of the product and service you offer. So really have your unit economics and pricing logic handy. They can be supported by bigger revenue projections for 12 to 18 months, but they are not a replacement for unit economics and pricing logic. So investors ask more questions in that than any other slide in your pitch deck. And the ask, really important here when you come down to the ask and where you say that how you will use the fund, slide number 9 and 10. If you say, okay, I'm going to hire 10 people, that's a red flag again for investors. If you say, I have to hire 10 engineers or 2 operations people or 5 finance team members or 3 industry experts to deliver something to a customer, then that adds value. Don't try to have your ask as, okay, I need to raise $1 million to hire 10 people. Rather, we are raising $1 million to hire 10 people with this skill set so that we can deliver XYZ to 100 customers in this market by end of 26. That gives a clear view for investors as to how their money is going to be used. And also really important to not go too deep into your funding plan, right? So just keep 3 to 4 buckets of how the funds will be used, keep it visual, make it more like a chart. And if investors have more questions, you can always clarify, but don't try to put too much that they don't even pay attention. So that's really important. And when in the last slide, when you're talking about how is your vision to use the fund to achieve your business growth, it's also really important to tie back to your problem that you started in the first 1 or 2 slides. So the 10 slide deck is more like a loop where you start with a problem, a solution, you share details on how you're going to achieve it, and then you tie back to solving the problem at a larger scale. They are not independent slides. Each slide talks to each other, but each slide talks about only one takeaway per slide. That way it's clean and it's also usable by different team members with the investor. Metrics, we've spoken enough. Use only key metrics in your first slide version. In your second and third conversation with the investor, you can add more metrics. Lastly, also in terms of the investor checklist, legal documents I'm not covering today because I'm not an attorney. It's definitely also part of the data room prep that you should do when you have the preparation phase going on, which is the first month. Your NDAs, your business formation, your cap table, like I said, advisor references, what is your IP status, if there is anything. All the legal documentation should also be collected along with your data room. In terms of due diligence, investors typically look at legal, financial, technical, customer traction, obviously team references. Those are like more in the second and third meetings, not necessarily in the first meeting. So don't try to show all that in the first meeting, because in the first meeting, all you're trying to do is ask the investor if they are willing to have a second meeting. Having a second meeting shows interest that they want to learn more about your product or problem that you're solving. And then you can bring in additional details in terms of metrics and other things. When it comes to metrics, always have a before and after scenario, meaning not trying to say, okay, I have 10 customers who repeatedly come and buy my product every 3 months. Show a before and after scenario, meaning first 3 months of 2025, we have 10 customers who repeatedly came back. But in Q2, we were able to increase that number to 20. Then this shows traction to investor that you are growing consistently instead of telling, okay, Q2, we have 20 customers. But is that an increase from the prior month? Then it's a good thing for investors. So it's really important to show that impact. And more importantly, metrics, always don't try to just dump metrics on a slide. If it's not relevant, investors will just anyway browse through. Always ask, okay, if this metric is there, how is it going to help with my fundraising? If it's helping, leave it. If it's not helping, remove it. It's not relevant for fundraising. And in terms of outreach also, when you outreach to investors, treat it more like a sales funnel, right? So how you are building your business, how you're acquiring customers. Similarly, build an outreach system or a sales funnel where you are bringing investors. You have a CRM system, which is nothing but a simple spreadsheet where you track who is interested, track them by stage, sector, check size. Sometimes you may find the right investor, but they may not fund the full check, which means if you're raising 500K, you may need 2 investors who have to give you 250 checks, right? Which means you need to keep 2 investors warm so that they are able to close the funding round at the same time for your business plan to progress. So really important to create this outreach system in a simple spreadsheet by different check sizes, sector and stage, and interested investors. And if someone has follow-up questions, I also mentioned a few times earlier where they like to get back on your responses little bit sooner, meaning it should be sometime within the same week. When you take 2-3 weeks before you can get back to the investor, they lose interest because, every day 100 to 200 startups are pitching to them. So then they may not come back and follow up with you, and then you've lost a good warm connection, go cold, right? And that's why it's also really important to do the weekly updates. On a weekly basis, share your progress, how you plan to grow, what is your ask. Even if you are still in an investor discussion, really important to share a quick email update. We spoke about it earlier. Just share progress on different aspects of your business, product operations, finance, technology, whatever that's relevant. What is your plan in each of those areas in the next month or next 3 months? What is your ask today? Sometimes it may not be a funding ask also. So you could be a B2B business and you really want a warm introduction from an investor to a corporation that needs to partner with you and give you a contract. So that could also be an ask. Ask need not be always funding and revenue oriented. And one more last thing before we close the session is, and we can go into Q&A. Like I said, this week we are in this session. Next week could be your week 0, which means take time next week, list some investor actions you want to do starting week 1, which is January. So it could be a Jan, Feb, March, 3-month sprint. Create a list of action items, assign real dates to your sprint, assign owners. Sometimes the owner could be you, owner could be someone else in your team. Not everything needs to be done by you. Add a completion date similar to how you track a product roadmap. Note dependencies, resources, share goals, and review them in your weekly team meeting. One more thing is, let's say after you close the funding round, don't lose connection with investors. Every investor you have reached out, except the cold ones who never responded to you, keep them warm because they may be useful for 2 things after you close the round. One, for a future fundraising round, or you fundraised today, you need them to make an introduction to you to some other business or customer that could help your business grow. So keep all investor relationships warm. Continue to send your weekly updates even after you close your fundraising round. And it's also important to share challenges in these weekly updates. If you are sharing good news all the time, then investors might be slightly doubtful because a business is bound to have some challenges. So it's good to share challenges and plans to tackle them in investor updates, because sometimes investors like to mentor the founders, meaning they might know someone or do something that could help alleviate a challenge for you. So it's good to be transparent in terms of both wins and challenges in the update that you send to the investor. And then obviously, we've spoken about the sprint, the deck, the metrics, the emails that you need to send, data room, how the due diligence happens. But if you have any questions on any of this, happy to chat more offline as well. One other thing you can also do is ensure some of the fundraising KPIs are directly also tied to your day-to-day business KPIs. That way you can track both together in one platform instead of trying to spend time on multiple platforms. And in closing, I just wanted to say that having structure, having the toolkit ready on a weekly basis is important. Be sure to pivot if need be on a weekly basis when you meet investors, get feedback, adjust, repitch, and continue the momentum. Definitely continue to keep the weekly updates to investors during as well as post the fundraising sprint. And in terms of the 12-week, it's a typical timeline. But if you think you can do it a little bit sooner, or if you need a little bit extra time, nothing is stopping you from making it a 10 to 15-week fundraising sprint. But like I mentioned, having a time-boxed approach is going to help you focus on your business and fundraising both at the same time in parallel. Metrics are important. In closing, I just wanted to quickly say, having investor deliverables handy before you start fundraising will save you time and also be more responsive to investor requests. I'll probably close here, take some questions, but feel free to connect with me on LinkedIn if you don't have a question at the moment, and we can always chat more later.
Yeah. I see Miley had a few questions. I don't know if you wanted to ask them yourselves, else we can read them in the chat.
Sure, I'm happy
I
to
can.
ask.
Yeah,
Hi.
go ahead.
I
Hey.
could not take notes fast enough, so I have to watch the recording, Bhuva, because it was incredible. So first of all, thank you both for creating the space for this. The first question is a little bit more tactical. You mentioned earlier in the preparation stage, you want to get a list of about 50 to 100 types of investors. Is that 50 to 100 in total, or do you think like per investor type, depending on the goal of the raise?
Oh no, in total.
Okay,
Because
okay.
yes, you're time boxing it, especially which means you have only 4 weeks to outreach and engage with these
Mm-hmm.
investors. You might, after the sprint, add 100 more, but for you to be focused and be effective to ensure these 100 really respond are
Yeah.
the right investors, a total of 50 to 100, like I mentioned, sometimes it could be a total of 50 also, depending on your bandwidth, because investors like personal engagement. And if you're not able to do that, then probably you're spending time writing emails that is not seeing the day's light.
Got it. Makes sense. The second question I had was a little bit more strategic around the optics of worst case scenario, the 12-week sprint happens and we're not able to reach the fundraise goal. Because of that, do you then expressly say that the round closes by whatever the week 12 is, and whoever doesn't close with you, is there an optics of that, of having to redo the sprint again in the later round and then like saving face around that? So what would be your advice on the external positioning around taking that bet in case you don't complete the raise?
Oh, that's no problem at all. Like how you do a product development, you don't build an entire product in one sprint. Probably you build phases of it in sprints. Maybe in your first 12 weeks, you have interest from 5 investors, but they need extra 4 weeks to close the round, which means you have a second sprint only for 4 weeks with these 5 targeted investors.
Mm.
And there is nothing like external optics. It is more like sometimes it is not the right investor for your journey. You don't want to close an investor thinking you need to close within a certain time. If it is not the right valuation or terms, you should take extra time to negotiate, because, like I mentioned, once you get that check, that investor is in your office every day. So you should be able to comfortably talk to them, share progress. So assume the first 12 weeks is to identify the top 5 as an example, with whom you may spend extra 4 weeks to close one check. Did I answer that question, or if you want to
That
ask
did.
me a
That was so
follow-up?
helpful. Thank you. Yes.
Yeah. So
Thank
it
you.
sounds like you're not telling people like, hey, I'm done my raise at this day. It's just a mental date for, hey, I'm doing these activities up to week 12. And if it takes longer for the money to come in, And so there's no optics of I didn't reach my goal. Um,
Yeah, because what you have done, you have reached a goal within this 12 weeks where you have shortlisted 5 investors from the 100 you started in week 1, which means you just have to now engage with the last 5, negotiate to the right terms before you are comfortably able to agree. It is not about, okay, within 12 weeks, I should make the investor agree. Sometimes it happens because you've reached the right investor with the right traction and there is a fit. Sometimes the investor may ask you a couple more questions, which may take you extra 1 or 2 weeks. But now you're not in your 13th week following up with all 100 investors. You're following up with those only few who are asking you more questions to close the round. It's in your best interest also to take this extra time after you shortlist, because you don't want an investor who's not invested in you, not just money wise, but in your business, on your cap table.
Thank you so much.
Thank you.
So I had some questions about like raise size, because some investors might go, oh, that's too small of a check size for us. And so I'm kind of wondering, what's the balance between like doing too big of a check versus too little? My understanding is most people are raising for like 18 months to 2 years now, because the timeline is longer, and so the asks are bigger. And so I'm assuming some of this due diligence is in phase 1, where you're kind of like checking your investors, checking your competition, and seeing, what ask you should be asking.
Yes, in preparation phase, you're not just shortlisting 50 to 100 investors to start outreach. You're also shortlisting them based on their check size. Are they even actively deploying capital today? They may have been actively deploying, let us say, in September, but they may not be deploying between now and the next 6 months. Then you are reaching the wrong investor. It's also really important, of course, like you mentioned, earlier we used to fundraise between 12 to 18 months. These days, 18 to 24 months is becoming very common due to longer cycles as well as multiple times that you have to engage with the investor within one round itself. That takes the founder's time. So what I have seen is people say, okay, I am raising 2 million as an example for the next 18 to 24 months. I'm also actively raising a bridge round for the next 6 months runway from angels. That could be smaller in terms of like 500K. What they do is they fundraise from angel investors and venture capital exactly at the same time. This is a hypothetical example, but there could be other variations. So your ask slide has fundraising 18 to 24 months, 2 million runway, bridge round 500K from angel investors, typical check size 10K per angel. So you are fundraising both at the same time. So if you find angels who are able to invest 500K, even one lead angel, that itself is a traction story for the venture capital investor to say, hey, I have an interested lead angel investor who is able to provide some bridge gap funding. Would you be able to come in as a secondary investor to do a follow on of the bridge round? So we can then do the bigger round. So there are so many ways you can approach this, but you should definitely write in your pitch deck that you are raising $2 million for a 24-month, and you're also actively looking for a bridge round of 500K between now and 6 months. So you are covering both investors, and that's very common.
Are there other questions that people want to ask? Feel free to unmute yourself or raise a hand.
I think my LinkedIn is also on the slide. So if there are additional questions, feel free to also ping me. Happy to answer them later.
Great. I mean, a quick one is like, what changes have you seen from 2025 to 2026? Yeah.
Yeah, 3 big changes. One is the fund closing cycle is very long. In the sense, typically you are able to close a funding round in 2 to 3 months. Now that's considered the lower range of the end, which means you are competing for less number of investors who are taking longer time along with other startups. So it's really important to put forward key metrics and traction and other details in the first time that your investors see the pitch deck, because they won't look at your pitch deck a second time if you missed some of it. So preparation is really important. That's one. The second one is earlier we had different definitions of pre-seed, seed, and Series A. So in terms of pre-seed fundraising, even if you had no traction, you can still fundraise. But in 2026 or in 2025 also, which is going to be a trend in 26, pre-seed has become like a seed round, which means you should have some traction in terms of either customer and or revenue, even to raise a pre-seed these days. So that's a second change. And the third change is trying to identify the right investor and are they actively deploying capital is really important. You may see a lot of VCs at conferences or in networking meetings, but if they are not actively deploying capital, you are spending time networking, meaning you can keep the relationship warm, but you're not actively fundraising. So many are, to just summarize, many are taking longer time to make a decision, which means the first time you meet them, it's important you share important data. Pre-seed is now more like a seed and not a pre-seed anymore. That's a secondary thing. And third is definitely people are raising multiple small rounds while keeping the eye on the bigger close.
Okay. I see Toby's asking a question. You mentioned a few things that investors are asked during the due diligence phase. Could you please share more information on this phase?
Yeah, so in terms of due diligence, you don't need anything separately. Basically, what due diligence means is everything you have made ready during preparation and engagement phase. They are doing a detailed review of all the documentation and every data. So due diligence simply means, let us say if you have shown traction data in your pitch deck and now you have had 3 meetings with your investor and they want to move forward with the funding discussion. Now they're going to go and do detailed diligence on each traction data you showed to validate it is accurate. Now you want to avoid making errors, because once you lose the trust of the investor, you might not gain back one more meeting. So due diligence is everything you have prepared in the preparation phase being detailed reviewed by investor team. Same legal aspects. If you have said you have X number of people on cap table, they all have so many allocations. If you have employee stock options, if you say that from a legal perspective, you have a clean business formation, they may not ask all the pertaining legal documents in your first or second meeting, but when you are in a due diligence phase, which is almost before the fundraising close phase, they're going to ask you every single legal document from the day of forming your company till date, including business, customer, and any other legal documents. So likewise, financials. You might have shown projections as to what you have gained in terms of revenue till date, what you plan to achieve in the next 18 to 24 months. In due diligence phase, investors are going to look at each dollar that has come in, each dollar that has gone out. How are you tracking in terms of unit economics and projections? So technical, again, if you say that you are using AI, you have a proprietary model that kind of makes your product a little bit more unique value differentiator versus your competition. When you are in due diligence phase, your investors tech team is going to review your AI model, review the IP behind it. Are there data challenges, data privacy, security challenges? Will we be sued in the future when they invest? Those are the diligence questions that they go through as part of their team. So quickly summarizing, whatever you created in preparation phase will go through elaborate detailed review in terms of hard materials, in front of investor team during the due diligence phase. The four major categories are legal due diligence, financial due diligence, technical due diligence if you are building a technology-enabled product or service, and then customer due diligence could be a B2C, B2B, doesn't matter. How are you tracking customers? How are they retaining, growing?
Nice. Does anyone else have any questions? I guess. Oh, yeah. So if no one else has questions, I mean, that will be it for today's session. I'm planning to upload some of our workshops onto YouTube. We'll also be sharing them in LumaBlast. I'm going to be starting a newsletter, hopefully in the new year. So please make sure to like subscribe to our Luma, which is lu.ma/FBL. And so I will be probably doing a blast either in December or in January. And I'll have links to the recording as well as other workshops that we recently had. And so, yeah. And then looking forward to seeing you guys all in the new year. There is a holiday party tomorrow at the Embarcadero at a art gallery. It is a charity fundraise. I posted about it on my LinkedIn. I'm just going to share it out. Unfortunately, I'll be flying to Montreal, so I won't be there, but I think it'll still be a lot of fun. So if you're in town and looking for something to do, have some art, listen to some music, enjoy some company with good people, that's available to you guys tomorrow evening. So. And with that, thank you so much, Bhuva. This was an extremely informative session. There was so much content information. If anything, I actually want to look at the transcripts to like gather all that information. And so, thank you for hosting. Yeah.
Thanks, Natalie. Thanks, everyone. Yeah, definitely look at the recording if you have follow-up questions. Feel free to ping me. Happy holidays.